Welcome to Kickin with the Rickens, redefining retirement. Gerry, Ricken, and Heidi Ricken Provost want to help you retire with purpose and live with joy. Find more information, including how to reach the team, in today's show notes. Now, Kickin with the Rickens, powered by Ricken Financial.
Thanks for subscribing. Thanks for downloading. Thanks for listening to Kickin with the Rickens podcast. We are here with retirement planner Heidi Ricken Provost and licensed insurance professional Gerry Ricken. My name is Mark Owens. We invite you to get more at rickenfinancial.com. You can get all the information here in the show notes. Thanks again for subscribing. Now, let's get to the show. We're going to spend some time this weekend here talking about your tax strategy. So when you talk about tax rates staying the same, Heidi Ricken Provost, Gerry Ricken, what do you mean by that?
If we were sitting here having this discussion about a year ago, Mark, every single topic we talked when it came to tax planning, we were trying to get ahead of when the Trump tax law was going to sunset, because the Tax Cuts and Jobs Act of 2017 was supposed to sunset at the end of this year. So January 1st of 2026, we would have been at higher tax rates.
So sunsetting simply means it's ending.
Yeah. In order for that to get passed, they had to put a deadline on it. So the deadline was the end of this year. So for years, the conversation around tax planning has been, how do we get on top of this before our tax rates go back up? Well, we do have a new tax law change. It went into effect on July 4th, the One Big Beautiful Bill Act. And when you look at the OBA, as I'll call it, because it'll take us forever to spit out all the other words. Sure. When you look at the OBA, it says that it's permanent now that our tax rates are going to be staying the same. Now, I say it says that it's permanent because we know for a fact there is no such thing as permanence in the tax law. Tax law may as well be written with pencil. It's always up for negotiation. And every election, every administration, we know there's always going to be changes. Mm-hmm. But what it did do is, in effect, get rid of the sunset provision, and we still have our lower tax rates come January 1st. So what does this actually mean for us? Because, you know, when we talk taxes, some of you are sitting here cross-eyed like, oh, they're going to talk taxes. What does that even mean? At the end of the day, you have the opportunity of time to do some forward advanced tax planning, because your tax rates aren't going to automatically click up into a higher rate come January 1st. So what this new bill has given us is the opportunity of time to do some form of tax planning.
And that's very, very important to have these tax rates where they are, because it gives us more flexibility than ever before.
Some of the strategies that they'll be implementing, we wouldn't have been able to implement because we didn't have the opportunity of time. And we all know time is valuable. Yeah. You know, think about the time that my dad's going to be able to spend with our cousins in Germany. That's something you can never get back. Mm-hmm. So being given the gift of time now for tax planning, there is so much that we can take advantage of while we have the opportunity to do so before our tax rates come up. And that's what we would love to talk to you about, because I know that taxes can be an incredibly complicated topic. You might be sitting here, and I was kind of joking saying it earlier, but if taxes make you go cross-eyed, we like to put it in real-world terms for you, and we can kind of dumb it down and explain exactly what things look like or could look like for you. So we'd love to have that discussion. Give us a call at 314-207-6211, 6211. And we can chat about it and see if there are any tax plans that you could put into your financial plan for the future and, you know, take advantage of the wealth of time that we've been given from this act.
RG3, Robert Griffin III, former quarterback of the Commanders. Now, back in 2012, he signed a rookie contract for $21 million. And he tells the Mighty podcast that this was his first real money moment and his first real money educational moment.
So when I was signed in the NFL, signing bonus was $14 million. So I signed it. They tell me, hey, it's going to get paid out over 6 months or whatever. So then when I get the full signing bonus, I only got, and I say only respectfully, $6.9 million. So less than 50%. I called my agent immediately. I'm distraught. And I'm like, oh my God, they took all the money out. Where is the 14 million? And he's like, Rob, it's taxes. You didn't tell me that they were going to take half of the signing bonus.
Celebrities. They're just like us.
Or are they?
Yeah. Well,
the numbers may be a little different.
However, it is a shocker to a lot of people on what they pay in tax, especially when they're retirees, because we believe retirees are the most disadvantaged taxpayers in America.
Thankfully, some of the tax penalties have been updated in most recent years, because there used to be a 50% tax penalty in place for required minimum distributions back in the past. But more often than not, the conversations we're having with prospects and clients alike are, why on earth am I paying so much in taxes when I'm retired? I don't have a paycheck coming in anymore. Why am I paying so much? This is crazy. The unfortunate reality is taxes don't retire when you do.
That's right.
The IRS is going to hang out no matter what. Some people will say Uncle Sam doesn't retire. Uncle Sam, I don't mind the image of Uncle Sam and giving him a few of my dollars. But if we put the IRS in perspective here, it's rough. They don't retire when you do. You still have to come up with some form of tax planning, whether you're in retirement or nearing it or 20 years away. You have to have a plan in place, because come April 15th every year, you still have to file that tax return. And if you don't have a stream of income coming in anymore, it's even tougher to cut those checks to the IRS.
And RG3 said it best, or without saying it. It's not what you make, it's what you take home. It's what you take home after you pay those taxes that's important. And that's what we need. That's what we strive to structure. How can we improve the amount you keep in your pocket and decrease taxes in retirement? That's what our firm's all about. We do lots of other things. We do money management. We do risk analysis. We do life insurance planning. We do long-term care planning. We do Medicare planning. We do estate legacy. Because we are
holistic planners. We want to make sure we're not giving you advice in a vacuum. So that's why we do all those things. But at the end of the day, we put a tax lens on all of it.
We put a tax lens on all of it because it's the most important thing. It's the biggest expense you will have in your lifetime is taxation.
Right. And if you don't plan for it properly, say your lifetime ends, because unfortunately, the reality is every single person's going to die at some point in time. So when we're no longer here, if you didn't advance plan for the unknowns for your demise, the IRS could end up being your biggest beneficiary of all of those funds that you have worked so hard to accumulate and set aside for the future and create your financial legacy with. And wouldn't that be horrible to think that you worked all of these years and set all of that money aside for the IRS to benefit the most? We want to help your family make sure they're in the best position to benefit from your funds. And there's a lot of different ways that you can do that. There are some beautiful things that were introduced in the One Big Beautiful Bill Act, the OBA, that can help kind of take advantage of some of that for the future.
One of the things that was put into place, the president wanted to reduce or eliminate tax on Social Security. Well, that did not happen. Let me repeat that. That did not happen. We still have tax on Social Security. However, to alleviate that and to circumvent that a little bit and help in that process, we do have a temporary standard deduction increase for seniors. That's if you're 65 or above. And this actually does sunset in 2028. So it's through the tax year 2028. So it's a short-lived provision, but every senior 65 and above is going to get an additional $6,000 of standard deduction increase. So if you're filing jointly, that's $12,000. So that will eliminate a lot of taxation on Social Security for a lot of people.
Also, quick caveat, this is the IRS. When the IRS is involved, there's always some sort of weird limitation in there. So there are income limitations on that. And if you'd like to know if you will be affected by the income limitations, or if you can take advantage of this additional standard deduction or how to do so, please give us a call at 314-207-6211, because every single person has a different tax situation.
Yeah.
We have no idea, what your tax situation is until we meet with you, but we'd love to meet with you and see how this may affect you. So if you'd like to talk more about that, just give us a buzz at 314-207-6211 or head over to rickenfinancial.com.
And when we talk about taxation of Social Security, it's a weird taxation out there. And I won't go into the calculation right now, but taxation of Social Security doesn't really have to rely on additional temporary additions of an additional tax deduction out there, a standard deduction. We can structure your assets so that you don't pay tax on Social Security.
Because your Social Security tax is based upon income coming into you outside of Social Security as well. So there are so many different streams of income you could have coming into you in retirement. And one of those that you may want to make sure you could maximize for the future, may be potentially wonderful for you, would be a Roth account.
A Roth is an account that you pay tax on the money going in. So you pay, this is after-tax money going in. But when it grows and when you take it out, you never pay tax again in your lifetime.
And since we're talking IRS, there are a couple caveats there. For it to be tax-free, you have to be over the age of 59 and a half, and it has to be in Roth form for 5 years.
If I had a nickel for every time Heidi has said those two items there, I wouldn't have to worry about
Sky
my
miles
trip to Germany.
Yeah, exactly.
You wouldn't, because you'd be able to maximize a Roth contribution with all those nickels added up there. You can contribute to a Roth during your working years. So if you have a 401k right now or an employer-sponsored plan of some sort while you're working, you can contribute either to traditional or Roth. There's pros and cons of both, but I'll tell you, if it were me, I would contribute more into a Roth than a traditional because I'd be able to save some taxes in the future by getting ahead of the problem. Because at the end of the day, there's two rules of thought. If you're going to garden, think about the tiny little packet of seeds you're going to plant in your garden. Okay. If you had to pay tax on that versus the entire harvest, that could be 10, 20, 40 fold from those seeds. Would you rather pay tax on the harvest or the seeds? I want to pay tax on the seeds before it grows into something bigger. I'll also tell you there's a huge common misconception because the tax law is so complicated that even when people dumb it down for us, sometimes you hear these things and there's these talking heads and no one really knows what the answer is, but there's a huge common misconception. So a lot of people believe that they might make too much money to contribute to their own Roth 401k. There are no income limitations when it's an employer-sponsored plan that has a Roth option that you're going to put money into. So if you do make a lot of money, you might not be able to open your own Roth account at a different firm outside of your employer, but there are no income limitations on that. So
there's a cap each year that the IRS sets for contributing to a 401k, but that cap does not include the match. So that's above the match. That's your cap. So, and if you're above a certain age, you get to contribute more. 50.
So please just know, if your employer has a Roth option at work, you're able to contribute to that Roth option at work. If you're confused, please know you're also not alone. And we'd love to have the chat with you, kind of break it down, show you, let's put some numbers together and forecast what the tax could look like, because we want every single person to make an informed decision. We don't just give blanket advice as a whole. You, especially when it comes to your taxes, you need to be making informed decisions for how to forward plan for your taxation. So it can begin with the purpose approach with us. Let's take a purposeful approach for how you want to live in retirement. And let's take a look at the taxation and how you might be able to reduce taxation in the future. All begins with a phone call at 314-207-6211.
And the name of the show is Kickin with the Rickens, not Cooking with the Rickens, because now as we continue our conversation about your tax strategy, what does salt have to do with any of this? Gerry Ricken, Heidi Ricken Provost.
Well, a lot of you just had lunch and you may or may not have used salt and pepper, but this is not the salt that we're talking about this time. This is state and local income tax, SALT. And that acronym has been floated out there for several years because
most of us didn't even think about this until tax law went into effect where we thought about it.
That's exactly right. So state and local income tax had a cap on it of $10,000 for the last several years.
Before we get into that,
yes,
what does that cap mean? Because when you file your tax return, you have two options for how to reduce your adjusted gross income before it becomes taxable income.
Yes.
Your first option is you take the standard deduction. And if you don't owe a lot of money on a home or have high state and local income taxes or charitable deductions or medical, deductions, something like that. If you don't have those, then most people will be taking the standard deduction because our standard deduction is pretty darn high nowadays.
And with the bonus with 65 and over now, it's even higher for the next few years.
That's what we're talking about here is standard deduction versus what we call itemizing. And if you itemize on your tax return, it used to be called the quote unquote long form, but you're going to file a different schedule, a Schedule A that shows here's how much state and local taxes I'm paying. here's how much money I gave to charity, how many things I gave away to charity. You know, you
My
might
mortgage interest.
exactly, you know, you'll have your mortgage interest in there as well. And then potentially some deduction from your medical expenses. But that's kind of what we're talking about here is the difference between your standard deduction and itemizing. So what's the big change that happened from OBA on the SALT, Dad?
SALT, the state and local income taxes, the cap was raised from $10,000 to $40,000. That's a huge increase. But a lot of people were forced into taking the standard deduction because of the cap on SALT in the past. And now they may be able to take advantage of that.
Yes, you may be able to take advantage of that if you fall into the income limitations because we're dealing with the IRS again. So, of course, every single person's going to have a different answer for whether they can take advantage of itemizing because of the additional SALT cap or not. If you really have no idea what the hell we're talking about or you need some help here, give us a call at 314-207-6211. You know, you can enjoy a salty little treat while you're meeting with us because we do have snacks all over the place. And yes, we do have drinks too as well to, you know, quench the thirst when we do talk about the SALT here. This can happen between now and 2029, and it may or may not affect your taxes. But at the end of the day, if you're close, say you can reduce your taxable income by that like $30,000. If your state and local income taxes are around 30, and you need some other things that you can add into your bucket here, so you might be able to itemize. There's some creative ways you can combine efforts to itemize. So if you're a charitably inclined person, yeah, you can give money away to charity all the time. You can give your things away to charity and they'll count as long as they're not a human being named Charity. They're a true 501c3 in the IRS tax law. You might be able to combine some donor advised funds in here too, because what a lot of people don't know is that if you're going to put money into donor advised funds, you can take a charitable deduction in your tax return to do so. So
in the year in which you funded the donor advised fund.
Mm-hmm.
So you can load up 5 years worth of contributions into 1 year and take that as a deduction if you're itemizing. The other thing what we can do is we can bundle deductions. And bundling deductions just simply means the way the timing of when you pay things. If you would pay things in December and January, why not pay both of them in December and get 2 years worth of deduction in 1 year?
So we know that
taxes.
State and local taxes always have to be paid. Your
Right.
property tax, your real estate tax, all that stuff has to be paid. Hey, if you can pay 2 years in this year, why not get ahead of next year's taxes if it's going to bump you up and be able to reduce your taxable income even more?
And bump it up against that $40,000 limit. Don't pay any more than that. But you have a $40,000 cap on state and local income taxes. So why not pay up to $40,000 this year, then do the same thing the following year?
And if you don't want to crunch the numbers yourself, or you need a little bit of help figuring out how close you are to towing that line, or if this even makes sense for you, that's when we'd love to step in and help you proactively plan for your future. So give us a call at 314-207-6211 or head over to rickenfinancial.com, RICKEN financial.com, so we can begin this conversation, because at the end of the day, it may or may not affect your financial future, but it doesn't hurt you to spend a little time with us and put a plan in place.
Well, Gerry, Heidi, thank you for the information and the education this weekend. Before we get out of here, Gerry, Ricken, Heidi, Ricken, Provost, take us home.
Every day is a holiday.
Life is short. Laugh hard.
This has been Kickin with the Rickens, redefining retirement.
Insurance products are offered through the insurance business Ricken Financial LLC. Ricken Financial LLC is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Ricken Financial LLC are not subject to investment advisor requirements. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Ricken Financial LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Ricken Financial LLC.
Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Tax preparation and tax advisory services are offered through Ricken Financial. These services are not offered by IPW and are not subject to investment advisor requirements. These services referenced are an outside business activity not offered through or supervised by IPW.